We tend to think that only naive people fall for financial scams. But right now, tech-savvy, highly educated professionals are quietly losing their life savings. Take a recent case reviewed by former SEBI executive director Pramod Rao. An experienced investor was promised an 8 times return on their money. They ended up losing 12 crores to the scammer. This chart shows fraud cases reported by banks over just a few years. Look at the total amounts involved in the right-hand columns. The numbers run into the hundreds of thousands of crores. It is a massive, organized extraction of wealth. To stop this from happening to you, we are going to build a personalized 4-step scam vulnerability audit. This is a mechanical checklist you can use to vet any platform or pitch. Before we start, grab your phone or open a browser tab. Bring up an investment opportunity you are currently considering, and we will run it through the audit together. Because anyone can be manipulated by a clever pitch, utilizing a strict mechanical audit is the only reliable way to remove dangerous human error from your investment decisions. Step 1 is the internal check. Audit your psychology. Scammers rarely need to hack your bank account because it's much easier to hack your emotions. They rely on your state of mind bouncing between extreme greed and intense fear. Consider the fake guru industry. They exploit greed by convincing people, even medical students and lawyers, to put a $5,000 online wealth course on a credit card. The pitch works because the victim genuinely believes the course will make them a millionaire, making the upfront debt seem trivial. On the other end of the scale is the fear of missing out, or FOMO. This is heavily weaponized in unregulated digital asset markets. In a classic pump-and-dump scheme, organized groups use private channels like Telegram or Discord to coordinate simultaneous large market buy orders on low liquidity assets. This sudden buying activity artificially inflates the price and the trading volume. Seeing the price spike, retail investors rush in out of pure FOMO. Once they do, the organizers immediately liquidate their holdings at those inflated prices. The market crashes, leaving the latecomers with irrecoverable losses. Look at the opportunity you brought to this video. If it makes you feel an urgent emotional need to invest right now, your psychology has been compromised. The investment automatically fails the audit. Step 2 is the pattern check. Classify the pitch. Agencies like the FTC and SEC actively track recurring scam structures. You can often compare your pitch against known documented models, whether it's a fake guru upsell, a multi-level marketing scheme, or a crypto rug pull. This illustration highlights a core tactic: operators deliberately masking their true identities behind legitimate-looking digital interfaces. If your pitch relies on a vague company structure or anonymous founders, it fits the pattern. That brings us to step 3, the red flag filter. The core reality of genuine financial markets is that they rarely offer guaranteed high returns. Aside from specific low-yield instruments like government bonds, risk and reward are always tied together. There is a simple mathematical rule to apply here. If the promotional material promises to double your money or guarantees an 8 times return, it is structurally deceptive. If the pitch matches a known scam playbook, or if it features a guaranteed high return, it is mathematically designed to steal your money. It fails the audit. Step 4 is the execution check. Verify the mechanics. The first mechanical action is the payment check. Set up a small, dummy transaction on the platform. On the surface, you might see a sleek payment portal claiming to be a major, trusted broker like Zerodha. Scammers borrow institutional trust to lower your guard. But when you inspect the actual routing details during that dummy transaction, you might find the money resolves to a random individual's personal account rather than a corporate entity. The second mechanical action is the regulatory check. You need to search the entity's name in official databases provided by agencies like SEBI, the FTC, or the SEC. Regulatory bodies utilize dedicated research teams, like SEBI's Department of Economic Policy and Analysis, to actively track market data. They identify and flag platforms that are not legally registered to offer securities or financial products. Simply trusting a corporate logo is a vulnerability. Forcing the platform to prove its payment routing and its legal regulatory status is the only way to ensure your money isn't funding a fraudster. You now have the completed scam vulnerability audit. Audit your internal emotions. Classify the pitch pattern. Filter for guaranteed return red flags. And mechanically verify the payment routes. Apply the absolute one-strike rule. If the potential investment fails even one of these 4 steps, it is not a viable opportunity. When an opportunity fails the audit, your reaction should be automatic. Close the browser tab, delete the message, and do not send the funds. Take a moment right now to save this 4-step checklist to the Notes app on your phone. Keep it ready for immediate deployment against the next can't-miss tip you receive. Building wealth requires finding good investments, but it also requires ruthlessly protecting your hard-earned capital from organized exploitation.